Meeting to order. It is 5:01. Can we do the roll call, please?
Chris Brune. Here. Ray Lapinus.
Here.
Connie Machini. Carolyn Schofield.
Here.
Lindsay Keisman.
Here. All right, any public comment? Seeing none, I'll move on to the approval of the minutes for the June 10th, 2025 Finance and Audit meeting. I need a motion. Okay, and a second. Okay, any discussion? Okay, all those in favor? Aye. All right. Okay, moving on to 4A, Finance Report for the period ending August 31st, 2025. Mel, do you have anything that you'd like to share with us regarding the report? Take us through it.
I don't really have much to add to it. We're pretty much on track for payments. We really haven't had any issues with agencies behind in their billing or anything like that. Admin right now, we're at 67% of the budget being spent at 9 months, so we should be around 75%. So doing good on the admin budget. We've had a few agencies that have capped out on fee-for-service already. And all the additional mid-year funding is reflected in this, so you can kind of see where they're at with that new funding. And overall, we're, just where we should be. We're going to come in slightly, well, I'm showing 1.5 of fund balance being utilized by year end, but this is also projecting, higher utilization for, Turning Point, which isn't going to happen, and a few other agencies. So I will next month start doing an adjusted total to show what a more realistic is, since we know we won't be distributing any more funds at this point. And then as far as the only other thing I'd like to point out is if you look on the page 7 of your packet, we've gotten a couple months in of the sales tax revenue, and right now we're projecting getting around 10.6 million in sales tax revenue based on the returns we've gotten. We were hoping for 10 million. So, that's good, and hopefully the trend, continues. We were trying to figure out why, the distribution we got for July was over $900,000, why it was so high when, it wasn't like a holiday month, or it was, it was just a normal month. So why it was much higher than what we expected. So that was nice to see. So we don't know if, collections are just getting caught up or what's happening. So hopefully we'll keep seeing that. But, in the meantime, we'll take more if we get more, right? Mm-hmm. So any questions on the finance report?
Yeah. Carolyn?
Thanks. Yeah, I was looking at the sales tax, and it did seem kind of odd that this year was very different than last year as far as the consistency within the months. It seemed a little more consistent last year. That's at least what we got at the end of the year. And I'm wondering, I don't know that there's any reason, but I also, am I recalling correctly that the way the state does the sales tax is you actually have to anticipate from last year's sales? Is that sales tax, or is that a different tax that they do that way?
I'm not familiar with that. I think it's just actual collections. If you look at page 14 of the packet, I kind of gave a breakdown of
yeah, that's the one I think I was
of what we've actually gotten. And you're right, the first 5 months of collections we got were all pretty consistent. 805, 807, 820, 824. But we're kind of all over the place this year. We had 981 for our December collections, which we got in March, so that makes sense because of the holiday. And then it dropped down to 795, 725, 893, 906, 976 for, 976 in August, which is May collections. So, like I said, the couple explanations, it could be they're just catching up on collecting the tax for us, or I don't really know why May sales would be so much higher than the other months.
Yeah, I'll
Because
be
it's
curious
right
to
up there
see
with
that-
December, you know?
Yeah, I'll be curious to see that year, if it's just January, February are historically low.
Yeah.
You know, and then we'll see that again. I think that just solidifies that whole, we need at least that year or two of information.
Right, to
really
see what
make-
we're actually going to
yeah.
expect, yeah.
Yeah, yeah, it's really interesting. I have to look at the legislation, because for some reason, there is a tax that they collect based on projections from the prior year, and then they give it back if it doesn't, if there's sales or, and I thought it was maybe sales tax by certain businesses.
Maybe,
I'll
I
look and see if it is.
I was
but-
under the impression it was actual collections,
Collection,
but I
okay.
might be wrong.
Okay, thank you.
I think it's an interesting discussion regarding earlier conversations we had about our fund balance, reducing it down to that 3-month versus that 4-month, and how much actual money will we need, you know, and how far in advance, right? Like when I see swings of more, you know, $250,000, you know, dollars in a month, it, you know, makes you feel like, okay, we got to stay a little ahead of where we're at. So, yeah, I agree. You know, our running concept of get more data, I think, still runs on from this. Yeah. Any other discussion or questions about that?
All right, then real quick, the opioid settlement funds. Just something to note, we got just under $300,000 in distributions. Of that was the 137 we did expect to come in. So then we had the additional money on top of that. And again, with this, we have no idea what we're getting other than an occasional, you know, we have, like I said, the 137 is the known, everything else are just things we get when we get them. We don't really have any pre-warning that we're getting these settlements, so it's always nice to see a little extra. And then we're still waiting for, I'm not sure why it's not on here. New Directions has not provided all the paperwork yet to distribute the funds for their capital project on the opioid funds.
Okay.
So any questions on the opioid funds?
Carolyn?
I just have one. Do they let you know when you get that influx of money like that, do they let you know what settlement that's from? Like, there was a big one not long ago. Like, is that it, or is that one still coming?
I think that one's still coming.
Okay.
They do let me know. I see the paperwork that shows, you know, what it's from. But there's so many different little settlements out there, it's kind of hard to know what to expect.
If maybe when you get that big one, I'd be curious to see what that amount is. Like when those big ones, the little ones, if that's a little one,
Yeah.
that's, you know, good to get that influx of
Well,
money, but.
you know, it's interesting because some of them, the settlements are paid over multiple years. Others, you just get a lump sum for that one
Right.
pharmacy or, you know, pharmaceutical company, and they're done. So it's, even if we get the big one, who knows if it's going to be chopped up into
Yeah,
10 little chunks or if it's going to be one big one. So, yeah,
It'd be nice to actually know.
It
when
would
they
be
settle
nice
it, what we might get.
to actually be able to plan for it and know.
That
And
would be
yeah.
nice.
I wanted to throw out there, I've been thinking about the opioid project as it has to do with our timeline and when our sales tax revenue will catch up, and we're looking years and years in advance, and the opioid settlement dollars, you know, they have an expiration, and, you know, my best understanding of it is, besides this magic settlement money that falls upon us whenever, you know, the dollars are only going to decrease over time. So, you know, there was some discussion within the last year about starting conversations around what do we do with that money? How do we plan for that money? And I think those conversations were almost focused more on, you know, bringing some key stakeholders in and seeing what they thought. But from a finance committee perspective, I think it sort of plays in some of our longer term planning too. If there are programs that, you know, are being funded through here and those dollars are going to, you know, disappear, or let's say we get a large, you know, settlement of money, is our position going to be that we will use that just to extend current programming versus spend it more? I don't think that's in alignment with the philosophy of what the opioid settlement dollars are supposed to be used for, which is right now for the issue that is right now. So I wanted to throw it out there. I know with, Bridget in your new position and with new staff coming on, I think that would be a really good focal point going into 2026 to maybe get some conversation, guidance, and thoughts about long-term planning and how that might play into our regular cash flow bucket as well. So, Carolyn.
And thanks, Lindsay. If I can add to that, because I know we've had this conversation before, and I don't know that we came up with a solid plan on those dollars. In particular, I think coming into the funding cycle, when, I do think the intent of those dollars, like you said, are more for the right now. So I don't like to defer, saying when they're kind of go to two projects. I don't like to have like a long-term project in the opioid settlement fund. So I think maybe having a plan on those conversations of making sure that we don't do that, create a program that we put into that, and then when those dollars run out, it's a program that we still need, that it's going to have to roll back into our regular funding cycle. So I don't know if it's a discussion before or maybe during allocations, but I don't know that it's, this year is as important as like next year. I think is critical to have that conversation and well before that funding cycle, so we make sure we don't shift people into that opioid settlement that actually need our are more for our long-term vision.
Any other questions or comments about the opioid fund finance report? Chris?
Sure, yeah. I mean, even my understanding of this was that really the original intention was that we were going to use like that money to do services above and beyond what was already being done. And that shifting people out of our regular funding stream into this allows for a, incredible provision of services across a wide range of providers, but longevity and like ability to sustain that over the course of time when we have people in this bucket versus the other bucket is worth talking about. We also have to think about, if we do have additional resources, we've focused on treatment and recovery, and we haven't focused very much on prevention. And I think that that's really part of the picture, having to do with, the vision of opioid settlement funds, I think, included that. And so when we think about how do we use resources in our community to help foster like a healthy community, that could be part of the discussion.
Yeah, I agree, and I know, and obviously this is with our previous executive director, I think that was where are there key stakeholders, for instance, are people that are already in this program, but to be thinking in the future of like, where are the gaps and who could fill it, whether it's an existing recipient or another, substance provider in our area. A little bit of that visionary work would be great to influence what's possible, what the gaps are, which I know is always a conversation that, Chris, you bring to the forefront. And I don't want that to get lost in the shuffle because it's far away and it's not far away is how I feel about it. So, yeah. Okay. Seeing no other comments or discussion, I will go ahead and move on to 5A, our investment discussion. So we've got Donna back. Thank you, Donna, for joining us again. If you wouldn't mind pressing your button for me, and I'll turn your microphone on. Perfect.
Good.
All right, you are all set.
Oh, good. You mean I couldn't have talked earlier? What?
Yeah.
Nice to see all of you back here again. I have a virtual partner who's going to join me, and I'm going to ask her to say hi. Her name is Kendra Shelland, and she is part of our new investment management team, and really excited about having her be here today to present to you the proposal that she and her team have worked on. So, Kendra, do you want to say hi?
Absolutely. Hello, everyone. Thank you so much for having me today.
The miracles of the internet, huh?
Yeah.
Right? So I'm going to start the first part of the presentation, and then we'll move into the second part, which is Kendra. And along the way, she may interject, or I might do that as well. So with that, first off, what I wanted to do was to just say, hey, our agenda is, let's just make sure that we're on track. You know how we have done some analysis as we indicated we would do. Then want to introduce the investment management team. So you just have an understanding of really the great experience that we're bringing in and the background of the firm we have brought in. I do want to mention that I feel really good about having two great investment managers. You met one of them, Bill Gregg from North Shore. And my feeling is you have to have two investment management teams. In our environment, two, I think, is plenty. And that way you have a way of offsetting and learning and comparing. So you guys will be recipients of, I think, yet another investment management option here with our excellent experts to rely on. Kendra is going to talk about the economic environment, and that is what we're talking about from the standpoint of the future. We aren't looking at what we have today. We're looking at where we're going tomorrow, and that's really why I'm here. The investment proposal then is something we want to drill down into. We want to explain to you the approach that has been taken, and then we want to talk about next steps. And I want to be clear, we're here to do business. We think this is the right direction for the Mental Health Board to go, and you need to help us with how we make sure that the proposal meets your needs. So with that, let's go to the first slide and just say, hey, this is kind of what we're looking at. I realize the opioid fund balance is not part of this overall analysis, but it is a consideration in terms of the services you provide and how you serve our community. The overall fund balance, what we see is $7.9 million. And something that has been done very well with this analysis, Melanie, very nice work, is identifying the budgeted expenses per month as well as the revenue, and we see a shortfall. One of the things you guys were talking about, go to the next slide, is the cash flow analysis. And again, great conversation by Melanie bringing up some important numbers. What you see in black is the 1.9 million that is where we see annual expenses exceeding cash flow, and that represents a declining balance. And so that is going to influence the investment management approach that we're taking. And how do we do that? Well, what we're going to do is maintain a $2 million in liquid funds to address the need for cash as needed. However, there's another part of that story, and we're going to get to that in a second. The last thing, however, that I want to mention, which you guys were also identifying, is that what we're seeing is current sales taxes, on average, are exceeding the original projections by about 50 grand a month, I'm thinking. And again, this is just MHB, not opioid fund, but I do want to make sure that I paint that full picture of your financial situation and resources. You know, the comment that Board Member Schofield made regarding sales tax revenues and why is that happening, great, question. And one of the things that our CFO, Carrie Whites, brought up, same question, why do you think that's happening? And her thought is a lot of businesses potentially were not contributing early on to that sales tax because they had not properly signed up for it. And as time goes on, they do get signed up, and that's where we see increasing revenues. I'm assuming that's based on her pretty extensive experience with sales tax revenues. So at this point, we're seeing some improvement in that revenue. I do want to mention, however, that our job is to work with you and look at our revenues going higher or our expenses going higher, or vice versa, right? And what does that mean? It means that we've got to be in a position where, as this proposed investment portfolio identifies, we want to attract that balance of liquidity and yield. You know, that is what is important here. And in doing that, you know, the portfolio will reflect that. And in fact, Kendra is, you know, she is in a position to explain further, you know, that overall portfolio approach. I think they're using some really smart investments, and I'll be excited to hear you see how she's approaching this. And the last bullet is we need to track those sales tax revenues. The sales tax revenues come into my office, so I am the first to know. And so given that, we receive them, then we report on them. But given that, you know, I'm your partner in looking at how those revenues are either staying the same, you know, getting increasingly getting bigger. But, you know, again, it's all about the trends. It isn't just that big month that we know is going to happen in November and December. It's not going to be that big month. It's going to be what's the overall trend looking at? And the more years we have under our belts, I think the better our knowledge will be. And that helps us then to optimize how much money should really go into investments. So with that, Kendra, I'm going to let you take over, and I may interject as you proceed, but please take it away. Tell us a little bit about PTMA.
Thanks so much, Donna. Yeah, so what you see in front of you is just a little bit of an overview of our company. I think first and foremost, what I'd like to highlight is a large percentage, I'm talking 97, 98, 99% of our client base is public funds. We do span across 27 states after our most recent merger. So we were previously PMA Asset Management. We merged with PTA to make the very creative name PTMA as a combined entity. This is honestly what we do is look at cash flows and understand how we can best serve our clients, understanding that in the public sector, safety, liquidity, yield are really our top priorities, and that's what we want to focus on. So that's really the approach we're going to be taking here. I work in Minneapolis with our investment advisor. We have about 15 or 16 professionals up here, so there is an entire team behind me that did work on this proposal and will work on the portfolio as well.
Oh, sorry.
We're going to turn it down just a little bit.
Oh, great.
Yeah,
Oh, sorry.
just might be problems with the online.
I just want to comment, kind of cut to the chase. What is being projected is rates going near that 3% level over the next year. And Kendra, if you'd like to provide a little bit of detail, but that to me, the graph is great. And Kendra is going to walk us through the graph so you have a sense of that, particularly the bar chart in tandem with the line chart at the bottom. But the headline is at the top, and that is where we're going to see some significant reductions based on what the economists at PTMA and I believe you're also looking at Bloomberg and their input. So go ahead, Kendra.
Thank you, Donna. Is this a better volume? Are we
Oh,
okay here?
you're great.
Awesome. All right. So yes, thank you for that. That is indeed what this graph is pointing out here. And really, what I want to focus on is why that's being projected to be going down that direction. So our Federal Reserve has a dual mandate, one of price stability and one of full employment. Price price stability being inflation. Inflation has been a bit sticky here after we saw a peak. A couple years ago, we started to see a nice trend downward in inflation, but we haven't quite gotten to the Fed's target of 2%, which is really why rates have remained elevated. Now, on the other side of that, we have full employment, and what we've started to see in the employment market is some small cracks, most recently with our jobless claims coming in a little bit higher. Now, if we think about some of the policy uncertainty that has come through in the recent months, and this year really with our current administration and tariff policy and how that's going to impact the U.S. consumer, this really has the Federal Reserve thinking about how they can protect that consumer. And just in addition to that, our consumer is still about 70% of our U.S. GDP, making us still a very consumer-driven economy. And GDP is expected to soften over the next few quarters, not necessarily go negative. So recession indicators have come off of their highs, but still a slower growth expected, which is really going to press the Fed into a position to start cutting rates. And what this slide is really showing is that the market is now anticipating 100% of a rate cut coming tomorrow, and then we expect to see subsequent rate cuts at every meeting since then. And to Donna's point, really bringing rates down to that 3% at some point mid next year.
And so what that means for all of us, because, you know, we're going to see it at the county as well. Those bank accounts that are currently getting Fed funds rate minus 15 basis points, that's going to be 3% minus 15 basis points. So you are now in that 2.85 range, okay? And that's a different animal, right? 2.85 is substantially less than what you're getting in the current bank rates. And of course, that's what you expect, right? I mean, these are you know, that day for Fed funds rate. And then the next day after that cut, boom, it will drop from, right now, we look at about let's say 4.44 or something, or you know, 4.6, whatever we're getting right now, it drops the next day to that quarter point. And it, as Kendra has mentioned, it just will continue to drop, so. Per the economists, right? We always have to remember investments is educated and intelligent decision-making about where the future is taking you. And so this is where we're at, and this is potentially where we're seeing things going. All right, we'll go to the next slide.
Thank you. And this is really just emphasizing, to Donna's point, what that looks like in the market. And so what we're seeing on this slide is the what we call the front end of the curve. So those money market rates. And we're going from a solid line to the dotted line. And that's really showing how the front end is really coming down and just emphasizing that reduction in rates that the market is anticipating. Whereas the longer end of the curve, so if we look out the curve a little bit more, you can still lock in some of those higher rates. And what this means is what they call a normalization of the Treasury curve, because the way we would invest, or you would think logically about a curve, you should be making more money on your longer term investments than your shorter term investments. And what this picture is showing us is that we're going back to that environment, and that's why we're proposing the portfolio that we are ahead.
Mm-hmm. Right. Yeah. And one of the things, Kendra, that you mentioned is that the Fed looks to be more in that 2% neighborhood over time. And the reason for that is to effectively fund the economic needs of, in this case, you know, our economy, but also to make sure that we're managing accordingly with providing some kind of return. Hey, Kendra, let me ask you, this is kind of a question that maybe somebody on the team is wondering too. We're talking about 3%, but what your dotted line is showing is actually about 3.5% in a year. So can you explain that dotted line thing? Because, you know, basically that's a little bit higher rate than what we were talking about in the, you know, the slide this slide here about 3%, near 3%?
Yeah, that's a great question because it goes back to exactly what you were talking about before. It goes back to the volatility that's in the markets and that what we're expected to happen isn't necessarily concrete going to happen. And I think one of the most important things to be looking at when we're thinking about what's happening in the rates market is the next move is down and not up. And so in our internal conversations, when we're talking about how to position our portfolios, we actually see the risk right now with the data that's coming through to getting, for the Fed to bring rates down to about 2.5%, but really that range is 2.5% to 3.5% by next year, depending upon the data that comes through. So the Fed likes to remain nimble, and they call it data dependency, and what that does is it moves the market up and down. So for example, when we got a higher than expected jobless claims, that rate came down because that indicated that the Fed needed to cut faster. Now, if we were to get any sort of data point that went in the other direction, you might see the market move right away. But that doesn't necessarily, that's just how the market's going to react as it moves through this. And one of the reasons for the proposal that we're putting together and active management is really aligning your assets with your liabilities to withstand that volatility as you move through it. And so it's kind of locking in those rates longer out the curve where there's a little bit more stability. So if you do start to see the Fed cut rates quickly, you're already locked in at that rate because that's where your liability was.
Yeah, and Kendra, to your point, can you tell us where were we? I think the first time I came to see you guys was maybe 6 months ago. Where was that blue line? 6 months ago in terms of, the interest rates. I know we've come down, but where were we about 6 months ago?
Interestingly, the long end of the curve did some very interesting dynamics around the announcement of our tariffs earlier this year. So I'm trying to think, 6 months ago puts us right in that tariff point, and what we saw immediately following our tariff announcements before the 90-day pause was we saw the long end of the curve kind of shoot up and go rates north of, like the 5% range on the 10-year rate. Now, I do like to say the markets react and then they kind of correct themselves after that reaction. So we saw longer end rates higher. They've come back into kind of a range that we've seen them in over the past year. The front end, particularly around the 6 months to year part of the curve, has changed really with every data point that has come through. And so again, the Fed only meets so often, and so they can only cut rates so often, but there's more data points intra-month, and the market's going to reprice that 3-month and 6-month and 12-month part of the curve based on that data that's coming through, even though the Fed can't action on it right then. Is that helpful?
Yeah, does anyone else have any questions concerning that? Okay. So, Kendra, go ahead and talk to us about the portfolio proposal.
Thank you. All right, so I know there's a lot of words on the slide. I want to talk about this before we get into the graphical representation, and Donna already did a great job talking about the first piece of this, or the $2 million we had earmarked for a money market. And why we have that there is after looking at the cash flow and looking at those ins and outs, ensuring that there's enough cash to be able to have the outflows before the inflows come in. So that keeps kind of a float there for those $2 million. That's really based on the cash flow. In addition to that, we want to build a diversified portfolio beyond that $2 million, and that beginning with one of our products that we offer called iPrime LTD. And what iPrime LTD is a mutual fund-like fixed income investment. And the reason I say mutual fund-like is because it is a pooled asset that is connected with iPrime. But it's got a little bit of a longer duration, meaning we're locking in a little bit more of that treasury curve out the curve where rates are a little bit more stable. It's an actively managed pool, which means that we're constantly reinvesting income. And so your pool is not only gaining the income off of bonds, but it's also being actively traded to create the highest total return. And really the highlight of this pool and why we think this is a great aspect of this portfolio is the access to the markets that it allows. So because it's a pooled product, it allows these funds to be invested in commercial paper, in other mortgage-backed securities, in municipals if they were attractive, as well as some treasuries and agencies and some of the more typical security types that you're used to seeing. But with a pooled product, you have access to that in a mutual fund-like product. And so taking a subset of that would really allow you to capitalize on the market a little bit longer out while maintaining this quarterly liquidity if needed.
Kendra, yeah, let me just bring up something. So what we see are yields that, are not what you're getting right now. In case you didn't notice, they are not. And one of the things that we want to make sure you are understanding, and frankly, Kendra and I talked about it a lot as well, is a very, very important concept here, and that is capital gains. When we are actively managing the portfolio, which is what we're talking about here with this active management, as we're doing also with the individual securities, meaning individual bonds, we are taking advantage of market arbitrage opportunities to bring in capital gains. And that gives us a total return that, combined with the market yield, we think is going to generate very attractive rates. And by the way, this is something that we've been doing for quite a while with our portfolios with the North Shore Investment Group. It's the same element of, it isn't lock it and you're done. It's buy attractive rate securities that you think may appreciate, and then when you sell them for liquidity needs or because you see an opportunity to buy, make money, and reinvest, then you are making a total return being the market yield, whatever that may be, and the capital appreciation, i.e. the sale of a bond that you bought, let's say, for $1,000, and you end up selling it for $1,100. And so now you have that additional amount of money that factors into that overall yield. And please take into account, my examples are simply examples to simplify the thought of total return. Anyone got any questions? And Kendra, you're certainly far more attuned to this than myself, but are there questions so that you have a sense of literally how are we making money for you? Okay. All right. Yeah. Kendra, if you'd like to talk more then about the individual securities, I think that'd be great.
Absolutely. So we just spoke about 50% of the funds that we were talking about there, around $4 million. And what we would do with the other $4 million is start to invest in individual securities. And what we could do with this is really align these with the expected, so going back to that cash flow, kind of align these with the cash flow and ensure that there's enough liquidity in the portfolio to meet any sort of cash needs that you have, knowing that this balance is currently declining. So we want to make sure there's cash readily available. And the way we would do this is we would put you into state statute eligible securities. And I'm going to start in a reverse order from what's on the screen here. But starting with corporate securities, and that's because with a corporate security, you're going to get paid a little bit more in yield and expected return than a treasury. So we would start to fill in this curve of where we can invest out longer with your expected cash flows in corporate securities. In addition to that, we would do the same with agency mortgage-backed securities. Now, agency mortgage-backed securities are wrapped by Fannie and Freddie, and so these are a very popular investment tool that also offer what we call a spread over treasuries, or an increased yield to treasuries. And so once we filled in this yield curve out based on your expected cash flow with what we could with available product in corporate and agency-backed securities, we expect there to still be about 10% of the cash left over, and that's where we would fill it in with treasuries. So that would be to fill in some time slots that we might need to fill in along the curve, as well as just increasing some liquidity in the portfolio for any cash needs as we talk about these expected or unexpected, heightened incomes or outflows that may come through. And so really what this diverse portfolio does, and having this dynamic portfolio between the fund-like products as well as the individual securities, is really set you up to withstand that volatility.
Sorry, you guys.
There is any unexpected cash flows in the future.
Kendra, I've just destroyed the beautiful conversation you were having with us by losing my place on the buttons, so really sorry. You guys, my apologies. I'm showing how poorly coordinated I am, so.
No problem.
Yeah. Do you guys have any questions regarding this? Let me just ask Kendra this question. So Kendra, in a declining market, and I'm specifically looking at the individual securities, but frankly, it could be true of the pooled, specifically the LTD product. But with individual securities, you lock in at, let's say, 3.8 with a corporate security, and then you have a declining interest rate, so now you can't get a corporate security for anything less than, let's say, 3%. What happens to the value of that bond if you go to sell it on the market?
The price of the bond has increased. So prices on bonds move inversely to yields. And so if that were the case, at that part of the curve, that's where active management can come in and make decisions to choose to sell bonds or to reinvest bonds and keep you invested at market rates and at the best rate that we possibly can, while trying to create that total return, going back to how Donna talked about actively investing that portfolio to really create or take advantage of any sort of capital gains, to your point, to create a total return that we would like to be higher than the yield.
Mm-hmm. Okay. Kendra, we're now on the pooled product and individual securities. So if you want to talk through that, and feel free to talk about the percentages as well, since the pie chart is very nice, but I did not make the numbers that big, so it's a little bit hard to read.
Absolutely. Sorry, I just lost my screen here. So, starting with 25% of the portfolio, which is that $2 million in the money market. And again, that's just driven from a cash flow. 25% of the portfolio in the iPrime LTD, that's a mutual fund-like product. And then the other 50%, we have 10% in treasuries, 15% in agency mortgage-backed securities, and 25% in corporate securities, keeping in mind, in Illinois state statute, we have a maximum of around 30% corporates. So something that as the portfolio starts to pay down, we want to be very conscious of and ensure that we remain within state statute with that corporate allocation.
Mm-hmm. And one thing I want to bring up is that we put these numbers in. You guys are the bosses. You're going to say how much you want to put in. Keep in mind that whatever you don't put in is subject to, those Fed fund rate changes. And it's also less accessible for us to move it in to make purchases and make changes to that portfolio percentages. But ultimately, you've got to decide how you want to proceed with the funds that you have.
Are there any questions on on the breakdown of the portfolio or where we came up with this breakdown, or any comments, suggestions?
I have a question, Kendra. So we have to keep a certain amount of money in a fund balance. It's about 3 months of revenue that, in theory, is supposed to be somewhat liquid if we need it. So am I understanding it correctly that if that was what we needed, the money market account is the most liquid? Am I understanding that correctly?
Yes, the money market would be equivalent to an iPrime or a bank account. It would be accessible same day. There'd be no extended period to get it out of the money market. That would be the cash surrogate, if you will.
And how about the iPrime? Is that also equally liquid?
iPrime LTD is going to have quarterly liquidity. And iPrime LTD is purchased in what we call NAV, and that's where it has the mutual fund aspect. And so that NAV will move up and down with the market movements. So you purchase in at a price, and you see it move, and then you purchase out at a price, and that's how you know what your return is in it. And so the money market would be your cash surrogate. Your iPrime LTD would be slightly less liquid with that quarterly liquidity.
And so if you need money from iPrime, you are going to have to wait for that quarterly door to open prior to accessing those funds. Is that correct?
Exactly. Now, and what's nice about the diversified portfolio is the individual securities for the other 50% should be lined up for an expected cash flow, and could also be there to help if there was an unexpected cash flow, if iPrime LTD wasn't lining up to the dates that you need. And so what's nice about this diversified portfolio is you have multiple avenues to access some unexpected cash flow needs.
And so on that point, if I wanted cash flow that exceeded the 2 million, which is very unlikely. I think the board does a very good job of maintaining a monthly average. But, let's say Lindsay, I'm sorry, did you say it was a 3-month reserve?
Currently, it's a 3-month fund balance reserve.
Yes, right. So that would speak to, over probably about, 3.8 million, something like that? Is that what your spend is?
Yeah.
Yeah. So in any event, if more cash was needed than what was on hand, how would you deal with treasuries, agencies, or corporates in terms of selling, and how quickly can you then put that money into cash reserves? Kendra?
Absolutely. So those securities trade T+1. They will, so if it's cash is needed, we can always sell those securities T+1 to have them available to be wired out the next day. You would be subject to the market movements on those securities. So it would be if the security price went up or down is where we would have to sell them. If it's an expected cash flow in terms of, maybe unexpected from the original cash flow, but say, hey, we think we might need some extra cash in 3 months, that's something we can address and look at the portfolio and attempt to raise those funds in an advantageous way for the holistic portfolio as we expect those, with any anticipation, whether it's 2 weeks, 2 months, or really, however you need it. The more notice, the easier it is for us to manage the portfolio to ensure that we're encouraging the portfolio to continue to grow while servicing the cash. But at the same time, these securities are all liquid. PTMA's philosophy when it comes to investing, I think really with our backbone being public funds, we really invest in high quality, high liquid securities, and we actively manage portfolios to out-yield some of the esoteric or illiquid securities that some managers do use. So everything we would put you in is highly liquid, and we would be able to move and make money for you if you need it.
One more question, Kendra, about that. I understand that we would be subject to, when we pull out the money, whatever the market is in that moment. But in any of these options in the portfolio, are there specific additional penalties with the different products for pulling out money maybe ahead of schedule?
That is a great question, because that would be what you would see with a CD. There'd be a fee for terminating it early, and that is not the case. These are all going to be tradable securities, and so it's purely where the market is at the time. There's no additional fee. iPrime LTD would have that quarterly withdrawal. If there was something needed intra-quarter, we would certainly try to work with you to get that sorted out. I don't think there would be any sort of fee associated with it. That being said, that's why we would build a diversified portfolio to help ensure that we can kind of make that all work for you, but no additional fees.
Thank you.
Along those lines, Kendra, relative to fees, one of the things that we talked about in our last meeting was the fees for your services at 10 basis points. When you were showing us the yields, were those net of fees?
No, those yields are going to be gross investment yields, where we see those securities in the market today. So that would be the difference between an asset manager and a broker. That's also a very good question. We would not take a cut on every individual security. We collect a fee based on AUM. And so we're not, which is assets under management. So there's no fee per trade. We're not cutting down a yield per trade ever. We're buying everything into the portfolio at gross, and you're being charged 10 basis points and to how many assets under management on a monthly basis, I believe is what the contract is.
Yeah, it is. It is 10 basis points. And can you give everyone a visual of what 10 basis points is?
Yeah, so what I like about these spread products, if we look at treasuries and agency mortgage-backed securities at 30 and 25 basis points over, even if you cut off that 10% fee or 10 basis point fee, you're still looking at a nice spread over treasuries. And so something that we're always looking to do is outmanage our performance. So essentially make your returns higher than what we're paying to essentially pay for our fee in and of itself through returns. That's always going to be our goal.
Does anyone have any questions regarding that?
I don't on that specific, but on the breakdown of the dollars, are you going to go further into that, or I was curious, like that 2 million, is that what is recommended for this, or is that just to show that?
I'm going to make this statement, then Kendra, you please take over. My understanding is that these are the proportions that they recommend, the percentages that they recommend.
Okay.
Ultimately, the actual dollar amounts that you say, not per se, I want in each area, but rather this is the total amount we are willing to invest, that we want to invest. And then the other dollars with the money market Kendra, I'm going to add to this. I think that's going to be driven by two things based on what I'm hearing from you and Lindsay, and that is it's going to be driven by both revenues and by your fund reserve policy. I think that could affect how much would be put in the money market, for example. Kendra, does that make sense based on the conversation we're hearing here?
Yep, that's absolutely correct. So if modifications need to be made to this, no problem at all. Again, the money market was the only one that was based on a cash amount. We were estimating that 2 million there. The rest were as percentages of the portfolio. So if that dollar amount needs to change in money markets and it needs to be a larger percentage, that's absolutely okay, and we can rework the numbers, or you can kind of see what the pie chart would look like if we were to do that as well.
Right. And the liquidity needs, the short duration needs, that just kind of limits the kind of returns that we can drive. And so, we're being very conservative here. Obviously, if you had other thoughts on how do we maximize that yield, then potentially these proportions, these percentages change accordingly as well. So, Kendra, would you agree with that, since I'm not the investment manager? You are?
Yeah, I think you said that wonderfully. Thank you so much.
I have a follow-up question. When you are proposing these different yields, are we to assume that this is over a one-year period of time?
The yields on the individual securities are based on a 2-year duration,
Okay.
which is still, I believe, still within policy. Now, the way we would, that's kind of an average. We took 2 years as kind of an average. We would ladder your investment out. I always like to make it look like a hill. So it goes up and down, so you're continuously reinvested with kind of the bulk around the middle of that duration. So that's why we used a 2-year average duration for the yields that we're showing on this page. Again, that's dictated by the cash flow, so if that changes, the portfolio can change in line with that.
And potentially your returns change as well.
Thank you.
Great. That was a really good question regarding durations. As we're going to see, the longer durations are going to be bringing in higher returns. So, and that inverted yield curve is, going to reward people that invest longer. And yet, got to have the liquidity. You've got to have that money when you need it. So, okay, we'll go to the next slide. And any questions regarding percentages? I know Carolyn asked a very good question on that. And this is really the balance between liquidity and maximizing yield based on what we understand. Of course, this is a conversation where we can have a little bit tighter perspective, given additional direction from you. And so where are we now? Well, we have conducted the cash flow analysis. Obviously, we can do a greater drill down from this committee or the entire board per your direction. Secondly, we need to identify the amount. And then in terms of the return of principal, I think we have established that liquidity at $2 million, but that actually may be more like $3 million. But the proposal reflects it at $2 million. Then the steps after that are, just perfunctory what we do. And my organization works with you to put together the bank accounts, the signers, set up the investments, and then the fun begins. And I will tell you, it has been a lot of fun because you get to see how much money you're making. And we really have done some good work in that regard. What you're going to see is, you're not going to see the returns that we have, for example, with the new money that we got from transportation, where they're making over 5%. But you are going to see better than what you will see if you stay with a bank account. And the reason for that is because you're going to be rewarded by making a commitment to a more sophisticated investment portfolio. Are there any questions on this slide? I do want to tell you that reporting can take any way you want it to, but we are going to really educate you as you wish regarding the money you're making, how you're making it. And that's something that has been kind of a signature of what we've done for our other clients. And so what are the questions that you might have?
Chris?
I just want to make sure that we can get, some information about the historic performance of each one of these funds, and also if there are other clients of the investment firm that we can talk to understand their experience of working with the firm. I just want to make sure that we do
Sure.
due diligence, because I think, we're
Right.
kind of stewards of these public funds.
Yeah, so let me answer the last question first. That's what I do. I'm your treasurer, I'm your county treasurer. We have about $91 million invested in these funds. And so, Q&Aing clients is really, the work that we've done. And it's taken us a lot of work to get to this point with this particular firm. So I would like to reassure you that your due diligence efforts have been completed by myself. And as your fiduciary, and as the county's fiduciary, I can assure you we've done the work needed to be done. The second question, and do you understand that? I don't mean to be arrogant or anything like that, but for you to talk to other clients is something that we do, right? And if your concern is that you are wanting to make sure your money is safe, then I can tell you we certainly have done that. But along the same lines, how do you know your money is safe with Associated Bank? Oh, because we do due diligence with them. And we're constantly doing our security with them. How do you know investment monies are safe with Schwab? Because that's the custodian. Well, again, the same situation. They are performing the security that we require, though we're constantly improving on that security as well. So there's many areas of security that are really encompassing your money. And we do that due diligence, right? It's more than just the investment firm. It's all these other areas too, where we're keeping the money. In terms of historical performance of these portfolios, I want you to take a look at this in the context of declining interest rates. It's like, oh, well, you're making this much, but I think you should be making this much. But guess what? The economy is, allowing this much. We are in a position where historical returns I think what we can get, Kendra, to answer Chris's question, which is a good question, is benchmarks. So we see, how are you, Kendra, you and PTMA with each of these investment areas? Potentially you should be able to show us how we're performing relative to benchmarks. And so that would be, Chris, industry benchmarks that provide for the types of bond mixes that we are investing in, and then also the pooled investments that we are investing in. Kendra, is that something that you could readily provide this committee?
Absolutely. We are what we call a GIPS verified asset manager, which means we are verified by an auditing firm that comes in to track our returns as we report them. And so what we do is we create composites of similar accounts and compare them to a benchmark to be able to show prospective clients what our track record is versus an industry benchmark. And so we could send along a couple composite fact sheets, one that aligns with our iPrime LTD suggestion and one that aligns with a little bit of a longer portfolio, what we call custom duration. And in addition to that, we have performance history on iPrime LTD because we have a specific fact sheet with that we could send along as well.
Yeah. Is that helpful, Christine?
Sure. I recognize that there's market volatility and that the performance is not going to be static over the course of time. But I think we can still examine these particular investment vehicles that are being recommended for us over the course of time relative to similar products to ensure that their performance has been consistent. And I feel like, that's our obligation. And, I trust your office and I appreciate the work that you're doing. And we're still in the position of having to be the decision maker. And I think as best we can inform ourselves is our responsibility.
Right. So I think that the, the issue of are we making the kind of money we should be making is when we get into the reporting part of working with our clients. And our reporting shows us how are we doing against the benchmark. So in this case, our investment manager is able to provide you with, the track record, which you're interested in, and that's the past, that's history. And we need to look at that, and that certainly is appropriate. But going forward, you also need to be looking at it from that benchmark standpoint. And that will be part of our reporting that we do for all of our clients when we do the reporting. So to say, are we doing the right thing here by making this choice? Yes, you are. Why? Because we do have a track record in working with our other clients. But secondly, are we doing the right thing, this last quarter of what we have achieved? And the answer there is, well, let's see how that reporting will show us that. And that will give us the input we need to move forward and either modify the portfolio or do other things that would address that benchmark. I will tell you that our benchmarks have either been met or exceeded with our other clients.
Chris, if I may, I have a clarification for what you asked. I want to make sure I understand it. You were interested in the products that were on the busy slide, as I'll call it, and that you wanted to know, for instance, if we took the iPrime, how it performs compared to like products out in the market? That's okay. Yeah, I just want to make sure we understand and, get everybody's concerns.
I think if I'm investing my retirement fund, I'm going to look at the kind of vehicles that are available to me, and I'm going to compare them over the course of time and see, which one has performed most consistently. Have there been radical shifts? Have performance expectations been met, relative to market volatility, all those things. So I just want to make sure that we do, that we're responsible purchasers and that we're examining carefully the products that we're buying.
Correct. So not so much related maybe to reporting, if we move forward, or previous reporting of a specific client, but actually looking at the products themselves and how they compare to like products, why those particular products are recommended by this company? Okay. Is that something that can be put together, Kendra?
Yeah, she indicated that. That she will provide benchmarks, right, for the iPrime LTD. And I would personally ask along the lines of, Chris, what you've asked is, can you put together benchmarks to help us with the individual securities as well? Because, understanding how you perform overall, I think, has a lot of credibility for all of us. Kendra?
Absolutely, and that's exactly what these fact sheets will show. What we call our custom duration would be closest to these individual security type portfolios. Knowing that the portfolio that we put together is going to be based on your cash flow, so the declining balance will indicate more how we invest those bonds out. So it's not going to be exactly apples to apples, but the kind of benchmark that we would use on an account like this would be something similar to what we would have on the custom duration. So to show your point, what you'll see is a consistent outperformance to the benchmark of all of our similar accounts in that strategy. And again, that's audited by the ACA. So this is kind of standard as to how money managers show their historic performance. It will also have some metrics on there that go a little bit deeper into some of the other metrics that you were talking about, how closely we align to the benchmark, or something called tracking error, and other metrics that dig deeper into that type of investment. So that would look at the individual securities, and then we would also be able to show our iPrime LTD past performance as well. So hopefully that will satisfy a lot of those questions. If there's any follow-ups on the fact sheets, we are absolutely happy to dig down into the data and talk much deeper about some of the data that's explained there.
Perfect. There's another question. Melanie?
Yeah, this is just more an operating. Looking at this proposal, you're talking about basically moving everything we currently have in our checking account, putting it into this portfolio, and then the money market account operating as our checking account. Is that kind of like the correct understanding?
Actually, I would prefer to see a monthly draw out of the money market
Okay.
into the, what I would call the associated fund balance for MHB. That's what I would prefer, so that you are continuing your relationship with, your vendors, et cetera. My staff will be pulling money out of those funds. So,
I guess
yeah.
my concern is just more like, right now, that's everything we've got in one portfolio, and I have, $150,000 to $200,000 every month. We're paying more than we have revenue, so I'm just trying to figure out how these numbers would even come close to working for us. Like, what would you say we would maintain in that associated bank account? What would you recommend?
Yeah.
I mean, we had this thought, do we need to keep our fund balance, the 3 months in cash liquid in our checking account, and then anything beyond that we can invest. But even at that, we'd still be spending that down. So I'm just kind of curious what you think we would maintain as
Yeah,
operating.
I think that your committee has to decide that. Certainly, you can keep. Let me give you an example. Valley High has about $19 million, roughly, and of that, about $2.5 million is in their fund balance at Associated Bank, which is, quote, their checking account, and then the rest of it is invested. And what they generate with that is about $900,000 a year, and that helps the gap of them meeting their expenses. So they are very happy that they have that, significant, like maybe 80+% of their money is in investments, and they've done very well with that. Others have different percentages. So senior services grant, I think they have a large, maybe even a larger percentage of theirs, and they're very similar to you guys because they are a pass-through. They take the money and every bit of it that they get out to their clients in need, and so. They have given us a certain amount of money, but they still have their own money with Associated. Now, it is funny, their own money is my money and your money, right? It's the county's money. It's the public in the county's money, but we manage that money as well. There was one thing I wanted to mention about this proposal, and I can't think of it. I think it was such an important point to make. But ultimately, the percentages that you choose, are going to be very much what you decide. Knowing that what you keep, on site at Associated is going to be money that's really, it's readily available, with the money market being, a day, the next day type transfer. And we work closely with the financial person, in this case Melanie, to operate on her direction. And we turn it around per your direction. So we've been doing that very successfully with ARPA, for example, where ARPA, they are spending money like crazy. And it's a great thing because of all the good things they're doing with it. But it's like not unusual to say, we need another $1 million in the balance. I just made a call today, said, hey, we've got about $1.9 million in for September. Is that going to cover it? No? Okay. What do we need to sell? What do we need to liquidate to make money for you? Now, in their case, they're operating on a lot of bonds that have done very well. So when they're liquidating, they've been making money at this point. And so they're making the yield plus the additional capital gain. So that has worked out well. But fundamentally, the way this works is very similar to how we work with you right now. And if there are additional requirements placed upon us by Bridget and Melanie, we're going to meet those needs, with the understanding of you communicating to us up front what your requirements are. And it's been a very successful approach.
I have another question from Ray.
Yeah, this is more for the committee as a whole. What is our expectation of, getting assets under management? We've been discussing this already for 6 months with rates dropping, potential income lost already. So I want to get a feel of what our next steps are and how quickly we can implement this.
I'll go ahead and answer that. I mean, I had a 5B Mental Health Board investment recommendation put on our agenda for just this reason, that, I was hoping this committee today could have serious conversations about what we would like to do, how we'd like to move forward, and per what Donna just said, I think we have to have very good conversations about what we think needs to stay in a liquid, checking account, essentially, what we would want to put forward, and that would give us a more exacting proposal, I assume, than this, the one that's right here. And my suggestion is that unless we have a hard stop concern that the majority of the committee members have, that we try to put forward a recommendation or a really quick next step. And if we can't do that, I'll call another meeting for us so that we get it done sooner rather than later, because I do think it's a time of the essence thing. So that's where I stand. I'm hoping for us to have some pretty significant conversation very soon, but I want to make sure we take advantage of Kendra and Donna and ask any questions that we feel we need to get answered from them.
Lindsay, I hope you'll forgive me. I'm going to interject here. One other reference point that I think that Chris raises the issue that I am a worrywart. Even though most people think I'm just the most happy-go-lucky person, I am not. I am always worrying, and that's what do they say? That's the devil's handiwork, right? But the point and the question Chris raises is such a valid question, and I want to take you back. Her question about how do we know this is safe, and there's a few things that I presented at my last presentation. I don't remember, Chris, if you were in that meeting, but it's fair for this conversation just to bring it up. So first, I'm your fiduciary as required by law. Secondly, investment can only be done according to the types of investments. I had somebody recently said, why can't we invest in like crypto or stocks? Well, because one, I don't want to go to jail, and two, it's completely inappropriate because one of my requirements is to return the principal. That's a big part of what we do, as well as the liquidity. The highest yield is actually not my first or second priority. So we have laws that govern what I do, and we have a contractual relationship with both of our investment managers that requires them to follow my investment policy. My investment policy follows to the T the Public Investments Act that has been in place by the Illinois state legislature. And so we have a lot of parameters around what we can invest in and what we can't. And anything that's under an A-rated security, for example, forget it. Do we get the best yield because we are limited? And the answer is we get the best yield we can with what we are limited by. And why? Because the public deserves to get their principal back. So that is another governance to answer your, again, very good question regarding the safety of these investments.
Did you say we're going to hear from the other investment entity that you?
No. He came, we moved as quickly as we might have at that point, but I realized you had a lot going on. Then he would have, we would have moved forward with his investment proposal. Now we brought on the new investment manager. They will be managing, Kendra will be managing the general fund investment and the ARPA investment and potentially some others. But that at this point is over $40 million they are investing. And then whatever percent that MHB may want to invest. So they're going to be close to that 50 million as well, I believe. Mm-hmm. And as you saw from their background, they're clearly capable of that. They have a very significant presence in the public sector. And let me tell you one, you asked about clients, Lake County, for example, uses them and has, I hate talking to the treasurer at Lake County about this because she's got so much more money than I do, and it really aggravates me. But I will tell you, PMA does a significant amount of business with Lake County, probably a higher percent of money than we do with PTMA. So that's a notable. And how long have you guys been with Lake County? I think, well, Kendra, I know you're not involved with that account directly. I know Brian and his team are, but I think you've been there about 8-10 years, based on what Holly told me. Yeah.
And on multiple levels with the iPrime relationship, as well as what we call, and what this would be is called a separately managed account, and that's the process for investing in individual securities. So we work with Lake County both on their cash investments in iPrime as well as their separately managed account, or kind of a reserve account, if you will, on both angles, for quite a few years now.
And the separately managed accounts are I really like those because there's an opportunity for higher returns, but given the high level of liquidity needs because of your pass-through status, we respect that, and thus the pooled investments we feel is a very good way to maximize our returns, potentially see that capital appreciation, yet still provide you the liquidity that you've just got to have.
So I'd like to, I think our next step will definitely be just conversations with staff and in this committee about, what amounts of money per your guidelines of what the next steps are. At some point, if the board decides to move forward with this, I know you outlined the next steps. Is there any delay in the time frame? Like if we said yes on a certain day, how soon do things get moving?
We could probably have the investment management team put this together with my team next week. We can move next week. What I would encourage you as your county treasurer is make a decision today or tomorrow. Move forward. Do not delay. You are not doing your constituents, your taxpayers, you're not doing them any favors by continuing to wait. I would be irresponsible not to make the statement with that level of emphasis. You have, as my friend Ray has pointed out, you've lost out on some good returns. And, again, there were some good reasons for that, but given all that you had going on. But there is no need to wait. You could start with, let's say, Kendra, one thought I had while we were talking is start with getting those separately managed accounts set up, thus, get your bond investments, buy some individual bonds and get that 50% of your portfolio in place. Continue to keep money into Associated, you're going to continue to see drops, but, keep money there for some period. Move forward and lock into that LTD as soon as you can. We can phase this in, but I would not start small if you are going to start with your separately managed account, i.e. the bonds. I would say potentially you're looking at maybe a $4 million buy of these securities and make that first commitment. See how it goes, and potentially then move into the other pooled investments. Delaying is not, optimal potentially, but taking an initial step and, being able to get comfortable with your liquidity needs, seeing how that revenue plays out, I think that's fair. So that would be one approach that you could take. But again, my input is meaningless if no decisions are made. And when I mean that, I mean, hours, days. But if it's a month or two, you're just going in circles. And that's not, you guys are better than that, I think, if you don't mind me saying that.
I believe that we should come up with a recommendation today. We can't do it tomorrow because of Open Meetings Act, obviously.
Oh, yeah.
But I think if we
Right.
come up with a recommendation, we can present it to the full board
Yeah.
Yes,
next week.
that's my goal
And
as
get that
well.
on the agenda.
Are there any additional questions for Kendra or Donna? Otherwise, I'll kind of shift the conversation into actual next steps, what people are comfortable with, dollars and cents, and go through one of the documents that Mel prepared as well.
Can we take a 5-minute break?
Sure. We're going to take a 5-minute recess. Can I get a motion for a 5-minute recess? So moved. Second?
Second.
All in favor?
Aye.
Okay, we are going to take a 5-minute recess.
Yeah.
If there's no further questions for me, would you like me to stick around or
No.
want to interrupt or intrude on an
Okay, back from recess. Could we do a roll call?
Chris Broom?
Here.
Ray Lapkus?
Here.
Connie Machini? Carlos Schofield?
Here.
Lizzie Kaisner?
Here. Great, I'd like to move on to agenda item 5B, Mental Health Board Investment Recommendation. After all the information that we saw, it was the goal for this committee to make a next step recommendation at next week's board meeting. So a couple of tasks that we have to do is talk about any general feedback that you have, and we have to specifically talk about, if we move forward, how much money we want to be liquid, how much money we would want to stay in a bank account, and the different strategies proposed of, partial money versus the most money. So I want to open it up to board member comments, and then also include our staff and their impressions, especially our fiscal operations manager, who has probably the best understanding of our cash flow needs on a regular basis. So if it's okay, I'd like to start with Melanie, your impressions, and maybe sharing with us kind of what you think we need cash flow wise, any concerns that you have, et cetera. Okay, Melanie?
My biggest concern is the unknowns. We just don't know what our revenue is going to be. We have a pretty good idea of our expenses, and we know that our expenses are going to be, 150 to 200,000 more than our revenue every month. So it's kind of a hard judge if we move forward and say we put $4 million into, the scenario where we just did the bonds, which I wasn't sure. I think that was a 2-year commitment. If we did, by 2 years, our available cash would be under $500,000. So I guess the biggest question is how liquid we need to be, how much we want to tie up. Because in the scenario where, Donna said to just do the the $4 million in bonds, you wouldn't have that money market accounts, you wouldn't have that more accessible funds. Or is she talking about doing the $4 million over, the full marketing plan with the 25% still being in money market? So, that's another thing to consider. What would be our plan going forward, going with that portfolio that was originally presented, but just with a lower starting point? Or just doing the longer term ones, or, it's, like I said, I'm just concerned about not having the liquid funds we need. But it sounds like we'd be able to pull it.
I have a question regarding, the comments that she made about quarterly access to dollars, right? Money market, quarterly access to dollars. It was my understanding that with the rest of the portfolio, they would also try to kind of put the term dates so that there would be other opportunities to pull out dollars if we needed to, right? And I do think that we're in a position where we're not going to wake up tomorrow and go, oh my God, we need all the money out. We're going to have advance
We're good for the
notice.
next,
Right.
rest of this year, all of next year, if we, were to.
What in your mind, because the question that I have is, how much, if we can have access to most of our money within, let's say, a quarterly range, how much cash flow do we need, in buffer is a thought process I have month over month, right? So if we know we're spending, what we spend each month, and then there's a range of sales tax dollars coming in that so far the data for me that I've seen is about a $250,000 spread from the highest sales tax amount to the lowest sales tax amount that we've received. Sort of leads me to believe that we should be looking at whatever our budgeted monthly amount would be, and the lowest data point of sales tax revenue that we have so far times at least a couple of months to give us that quarterly output is, and I just want to throw that out loud. I'm open to full board member discussion, Melanie,
I guess a big question is the timing of the revenue versus the expenses going out, and and what we're comfortable. I mean, you could just, say invest everything but $1 million and just work with that $1 million and just pull money as you needed to cushion that, and you'd probably be fine cash flow wise as long as you have the ability to, move the money. So because you're talking covering 200,000 every month essentially, and it's more of a timing issue than anything else. So I mean, the money's still accessible. It's just, more concerned about any long-term where we might potentially, well, I guess there wouldn't be penalties, but you might potentially lose out in some way there. That would be,
Dollars come in consistently.
yeah.
That's the other concern.
Bridget, if you have a comment, would you mind turning your microphone on so we can hear?
I was saying, as long as the dollars come in consistently as shown, it's a little concerning, as we've said, you have been saying this all along, is that we don't have enough data to show. And it is concerning that what if we see a big dip in the sales tax? It is.
Yeah, and a lot of it, I can look into it more, is just like the timing of when it's going out and when it's coming in. Because I know a lot of times the treasurer's office doesn't even pull the money in from the state until the end of the month, even though it's issued around the 8th of the month. So I want a better clarification for her when, is there a reason why we get the money so late in the month? Can we get it sooner in the month? So we're not in any situation where, yeah, I got 900,000 in, but I also, before that 900,000 came in, I spent $1 million, So I guess just a better feel for the timing of when the money's going in and out would be a good thing. But I mean, as long as we have, we don't have to have that full 3.3 million fund balance sitting in cash in an account, but we do want to have enough of a buffer to make sure we're not, that we're able to make payroll, that we're, cutting checks and paying the checks. So that's kind of the number I'd want to kind of work with more, just like the timing of things going out. But I mean, as long as you do leave that buffer and you have, the liquidity of, that $2 million or whatever in the money market that you can move around, I think you'd be okay investing more than we think we're probably comfortable with.
Right, so as an example, 2 months of operating expenses liquid in the checking account, in theory, I think is probably more.
Right,
It-
probably
It's more than necessary.
More than necessary, exactly.
But it would be the buffer for the unknown, potentially.
Right, and until we get that timing down, until we can really truly see, I think you'd be safe with that amount and be able to invest the rest in some format. I don't, probably the portfolio split, that she presented would probably be good with like, the $6 million there and leaving us $2 million in cash or something along those lines.
Right. So $2 million in that account and
Well,
then
that's just a number throwing
appropriate.
out, yeah. That's close to like a 2-month buffer.
Correct.
We're basically spending, right around $1 million and a few thousand every month. So 2 months would be
$2 million.
$2 million.
Ray?
Yeah, my understanding with regard to the bonds, the agency bonds, the treasury bonds, and the mortgage-backed securities, is the 2-year commitment, but it's like a stock. We can sell it. You just lose the potential of the full earnings by selling it early. I view the buffer a little differently. I think of the bank account, Associated Bank, and the money market should be the buffer. And what we need to, the difficult number for you to come up
Right,
with is,
yeah.
what is the bank account number going to be? And then create that monthly transfer.
To keep it there.
To keep it there. So I'm thinking, why not overthink it? Put the 2 million into the bank account, and month by month, as we see that we can, populate the money market more and more, go from that standpoint. But, follow the show, that percentage she showed, money market was 25%.
Right.
So whatever full dollar amount we want, 25% of that should be in the money market bank account column, and then the rest of it just falls into the percentages they provided.
Right.
So what's the number?
So if I understand correctly, if we're going to keep, let's say, $1 million of operating in the checking account every month, our current balance is right around 8 million, then our total invested dollars is around 7 million, and 25% of that would be, are you saying 25% of that would be in the money market account, or are you saying 25% would include the money market and the checking
25%
account?
was what she was projecting, or putting in the proposal for money market, 25% of whatever we invested.
Yeah, I think.
kind of
that
what she was-
I think that would work out well, because if we see that we have more money, we can, potentially put it into the I prime and kind of tier that I prime too, because that's quarterly. So if we put, X a dollar amount, quarter 1, quarter 2, quarter 3, quarter 4, then we can liquidate that on a quarterly basis, as opposed to
Yeah.
having a running, almost like a laddered schedule.
Okay, Carolyn?
Thanks. I was really similar mindset to what Ray was thinking. Was kind of looking at those numbers. I did not feel comfortable. I don't know where they got the 8 million from, was why I asked that question.
Well, that was pretty much every penny we have in our account, essentially,
And
yeah.
I think that she kind of answered it like it was up to us as to what that number was going to be. So when I was looking at it, I guess I was thinking of that investment number of like 6 or 7 million, depending on how we wanted to divide it out. I just think for simplicity's sake, maybe either that 6 or 7 million and then just kind of dividing it equally. And I mean, Ray, or I was thinking if we wanted to peel off a certain amount to keep in the checking, and then whatever number was left, leave that. So that's why I guess I was thinking that 6 million, because you're still left with, like 1.9 according to what's going to be in the future. So I guess just pinning down that number, I'm fine with doing this, but I'm more comfortable with that 6 or 7 million. I don't think I'd be comfortable with anything over that. So just ensuring that that money market does have that 3-month reserve, and between the money market and the checking account have the overage that we need for several months, and then that 3-month reserve in there too, and the ability to switch around when need be. But
And we can take the temperature of, the full board. We could, do 5 million, as long as we do something.
yeah.
Yeah.
And then we have the ability then to take out of that buffer and again, populate it.
Right.
We don't have to, jump in, full
Well,
crazy.
True, I mean, there's nothing to say you can't invest more later if we find that that buffer is more than we need, or,
That's what that was the other option. Like, did we want to take like 3.5 or 4 and put it in the securities? I mean, I'm not that familiar with how that works versus the other. To me, the rates didn't, they
they didn't vary that
they
much.
didn't. In fact, I thought it was like the money market that looked,
Yeah, the money market had the higher
Right
return,
now.
yeah.
But I
So-
think that's the one that's most volatile to the
Yeah.
economy.
so I
Yeah.
guess you could take it and, I don't know, move it if they change, or I don't know. That's why I guess thinking you could just take 3.5 and then the rest you could kind of divide amongst the checking account, the money market, and the I prime. I don't care on the mix of that, but having a little buffer is definitely where I want to be. And I think, I don't know who wants to come up with the percentages, but Lindsay, you're
I'm
Yeah.
looking at the screen behind you, and it's like, we just need to come up with the numbers.
to fill in there. Yeah,
Right.
exactly. That's how
To
I'm
our
at.
company.
Yep, I'm good.
So let me, okay, Chris up?
Okay. So I want to make sure I'm following, because y'all are way ahead of me. So Lindsay, you talked about, our fund reserve needing to be liquid. And so then I'm like, okay, well, does that mean it can be a money market account? Does it mean it's in our checking account? What does liquid mean? Obviously, if we can't
I
get
think
it
it's up
for-
to us to actually decide
Okay.
how liquid it is, so, I mean,
Well, and that's also that's our reserve. So that's supposed to be, in a vehicle that is, I think, kind of protected from market volatility. She was talking about regain of principal. So, that's 3 million plus-ish for a 3-month fund balance, right? So that one we are saying needs to be liquid. And we're going to spend if it's $200,000 a month, then it's $2,400,000 for the year that we're going to spend. Like, we know we're going to spend it, right? And that's the max, because Mel is saying 150 to 200.
yeah.
over the money that comes in. That's what
Right.
we're spending right now, because we're spending down fund balance. So if we put the 3 million and the 2,400,000 together, that's over 5 million that we really need to be in a fairly accessible liquid stance.
I think so the way I would explain this is, we have a timeline that we pretty much know is going to happen, right? So in the next 2 years, we are just simply not going to have a problem. I mean, short of this board, throwing dollars at everybody that walks through the door, right? If we were to keep along a funding flat kind of methodology, we have more than enough money. There is really zero reasons why we need our fund balance to be liquid. As we approach kind of the 2029, 2030 time zone, we are going to potentially need to actually use those dollars for operations. So for me, how liquid it needs to be is not very much right now. But I think it's also policy that we have to talk about is like, do we as a board want to have a policy about our fund balance dollars and how liquid they are and how not liquid they are?
I don't know that they necessarily have to be liquid, they just need to be there, correct? I mean,
Correct.
so behind you is the forecast of, where we're going to be as far as using fund balance? And where we'll be at as far as where fund balance is at?
Did you have something to say?
I just wanted to say that
Hold on. Yep, Carolyn?
I just think the whole concept of the fund balance is if our revenue source stopped today, that we would have access to it. So we need $1 million to be accessible in a month, we need another $1 million in 2 months, and we need another $1 million in 3 months.
So basically, sales tax revenue just stopped, period.
Right,
Oh,
I think
yeah.
that's the whole philosophy. Like, if everything shut down, we would still be able to go for 3 months. We don't need $3 million today. We
No.
need $1 million by next month, $1 million after that, and $1 million after that. So I think
And
it's
even
just
if,
fair to
all of a
liquid.
sudden sales tax dropped off, it's not going to completely go
Right,
away.
right.
Well, if it does, then we got more problems than where our fund
Right,
balance
yeah.
is.
Yeah,
Right.
I think actually any of these probably would fall within that liquidity that's needed for fund balance. I mean, with that one side of it being obviously the monthly or quarterly being more guaranteed as to what you could access.
I think I agree with you. I guess what I was trying to say is that until any, entity is at the bottom of its cash flow pile, even if sales tax dollars stop today, we have other dollars right now that we won't have in a couple of years. So the need to access that, so for me, I personally could take the stance that the risk of a higher yield in a longer-term option is worth it for our fund balance dollars, because the hope and theory is that we don't ever actually have to access them. And in the awful circumstance that we do, my understanding from what they said is really we're just going to miss out on the gains that we would have otherwise realized in whatever the term is that we thought we were going to lock into. So that risk profile to me is low right now, but it wouldn't be low if we were making this decision 3 years from now towards the bottom of our excess cash flow, is maybe my stance on that. So, how liquid we need it, I don't think we need that much money that liquid right now. At least that's my take. She gave examples of other departments that pretty much just transfer from their money market account what they think they're going to need that month in operational expenses. It's really a pass-through account for all your vendors and things. Personally, and from our fiscal operations manager, I think we could get more comfortable over time reducing that amount. So right out the gate, if we wanted to say, we want, a month plus buffer dollars in that account, and even 3 to 6 months from now, we might have a better feeling for how easy that is. She said, you want money out of your money market account, it's the next business day, is what I heard. So, there's not a world where Mel should be in a situation where she doesn't know that she needs money by the next day, you know? So I see that as just very, very low risk to do that, to, you know, put the money in there. Ray?
Yeah, the only thing that, you know, the qualifier is that Mel has to have procedures in place with Treasury to get that transfer approval done in a day.
And a more committed, better understanding of when they're going to be pulling in our revenue, so I have a better idea of how the flow is going to work.
Yeah.
So
Do you know, Mel, what our interest rate is on our bank account?
it's currently 4.44%
Yeah, so
as of this past month.
Yeah.
Yeah.
Yeah, gonna go down tomorrow.
Well, the same with the money market as well. That's why we're looking at these other things.
I mean, you know, historically, Donna came in and had this conversation, I believe it was about November of last year. And, you know, we heard some of the similar things, that our bank account would go down, and quite honestly, you know, it's worked out for us. So.
Yeah, I don't think we really lost anything except for potential, you know, longer-term ones that we didn't. But I don't think that she was offering anything higher than what we were already getting,
Correct.
so.
Because you know, the history of why Donna was in here in the first place in November is because we thought we were going to be sitting on a considerably larger amount of money that we were not going to have to use, and longer-term investments would in fact yield better outcomes than our current Associated Bank checking account. But if what she is to say is believed that we will be in a better position investing in this direction, so far what I've heard, if I'm going to recite it, is, I'll throw it out there again, 2 months of operating expenses, you know, to leave in the bank account. We do the 25% total between the bank account and the money market account, and the remaining percentages of the money left. So to me, that puts us somewhere around your $6 million mark, I believe.
Yeah, pretty
of
close to that.
investments. Is that a good summary of what I've?
So basically, you're saying the 6% with the percentages split up as she's outlined with, or $6 million with the 25% going to the money market, then 25% going, you know, breaking out that 6 million in those percentages and that proposed profile.
And then leaving the other approximately 1.9 million in the checking account, with the understanding that as you get the procedures in place with the treasurer, we have more information. If we feel like there's advantages to shifting some of those dollars out of the checking account.
We have that
then
ability, yeah.
We would ask staff to go ahead and do that. Is that a good, any feedback, thoughts, concerns about that approach?
I'm personally okay with that. It gives us kind of a comfortable buffer to work with initially to evaluate, and then having the money in the money market account that's, you know, is easily accessible is also a good buffer. I mean, the nice thing with us is our expenses are pretty level. You know, we don't have too many big ups and downs, so yeah, I think that would be, I think, one of the better options to go
Okay.
forward with.
Is anybody on the board concerned about moving forward with Donna, the firm that she presented us today? Any discussion about sticking with our current bank account system versus moving into the treasurer? Chris?
No, I just think she's going to get us some details about the investment instruments that they're discussing, and hopefully that can go out with a packet that goes to the board for their review.
Okay. Yeah. So if we could get the benchmarking that I think Kendra was going to provide out with the full board packet next week, then I think our recommendation will be that. So I know we were talking in whole numbers, Mel, if you could please prepare something with the
Exact, yeah.
the exact numbers and, that we could go ahead and make a recommendation to the board for that next week. Any further discussion? 'Cause I'd like to get the specifics of that maybe outlined on paper as a presentation. And then, is there anything else that we needed from Donna or that you wanted besides the benchmarking? No? Yeah, Ray, there you go.
Not to beat a dead horse to death, but Sarbanes-Oxley is one of my favorite things, to have even though we're not thinking of doing the transfers initially, having that structure and approval in place. I don't know if we as a board have to authorize, finance to be able to do that transaction. Who has to approve it? Is it 2 officers or such, or the full board? We might want to think about that.
So you want some kind of financing committee or investment committee kind of in protocol and
Yes.
kind of draft it up? Went to a training on that today, so I'll look into that further. Timing was impeccable.
Again, there's oversight, no matter whatever we do, because it's got to go through Treasury.
Right.
It's not just going through you, but for us as a board to show that we have ownership of the process, so it wouldn't be the Treasury on the county side starts moving money without our authorization.
I think when we did this before, I think the choice was to give our executive director kind of authority to invest, right? I mean, it was broad, is my recollection, late last fall. But I agree with you. I guess what I'll say is it'll be an interesting conversation to see what we want to go through Finance Committee, because some of what we're describing here is a need to be nimble, which doesn't mean waiting for a Finance Committee all the time. So as you said, a two-person's decision on those kinds of things are always nice. Carolyn?
Yeah, and I agree. I don't think it needs to go to this committee, but I think that process in place is kind of, it can be a simple process, but one that's defined, can it be electronic? If it's electronic, who makes that, who has access to that? I think that is really good to have that all spelled out prior to any sort of movement. Should be easy.
Yes.
I'm assuming it should be, we're not looking for anything too complex.
No, we're not like making up our own rules.
Yeah. Hopefully they made the document for you and you can just
Well,
put our name on
they
it.
told me where I can get some good examples. So.
Okay, there you go. All right. Okay, so in summary, our recommendation is for approximately $6 million to be divided amongst all of the percentages, the remaining balance to remain in the checking account. And then we would like some staff to develop some protocols, standard operating procedures for ensuring that money is being moved and has proper oversight. Is there anything else? Yes, I do. I just want to make sure we're all united before, and if there's any further discussion.
I'm good.
Good, okay. Then can we go ahead and, does somebody you want me to say the recommendation over again?
If you want to say it, I'll make it.
You can do it. All right, so the Finance Committee is going to instruct staff to work with the county treasurer and make a recommendation to our full board that we move forward with $6 million of investments put forth in the proposed percentages, and the remaining balance to remain in our checking account with future possibility of reconsideration. And in addition to that, that standard operating procedures will be put into place for staff oversight for dollars being moved to and from, and presented as well to the full board.
And I will make that recommendation as stated by Lindsay to bring it forward to the full board.
Okay, second?
I'll second.
Okay. Got to vote on here, don't we?
I'm going to roll call.
Okay, roll call.
Chris Brown? Ray Lapinus,
Yes.
Connie Machini, Carolyn Schofield, Lindsay Keisman.
Yes. All right. There is no new business, so therefore, our next meeting's Tuesday, September 23rd. I need a motion to adjourn. All right, second? All right, all those in favor? Aye. We are adjourned.